Hello and welcome to this session on various credit rating agencies. In this session you will learn about credit rating agencies, role of credit rating agencies, credit rating agencies in India which include CRISIL, CARE and ICRA, top credit agencies around the world amongst which we will cover Standard and Poor's, Fitch and Moodys. Let us begin with an introduction to credit rating agencies. A credit rating agency is a company that assigns credit rating which rate an issuer's ability to service the debt by making timely interest payments and likelihood of default. The primary role of a credit rating agency is to facilitate the trading of securities on secondary market. It affects the interest rate that a security pays out, with higher credit ratings leading to lower interest rate and vice versa. Let us take an example of this. An investor would be willing to accept a lower rate of return for a security that has been extremely high credit rating. This is because the chance of credit default risk is low. Likewise, if a company is unstable and has a low credit rating score, investors would expect a higher return to offset the risk of default by the company. Credit rating agencies only rate creditworthiness of institutional parties such as companies, special purpose entities, state or government bodies, non-profit organizations, and sovereign nations. Individual consumers are not only rated by credit rating agencies but also rated by credit bureaus which issue credit scores. Also, by serving information intermediaries, CRAs increase the pool of potential borrowers and promote liquid markets. These functions may increase the supply of available risk capital in market and promote economic growth. These credit rating agencies provide unbiased opinions. Unlike brokers, financial intermediaries and underwriters who have vested interest in an issue, credit rating agencies are meant to provide an unbiased opinion. The rating agency has access to a lot of information which may not be publicly available. They also have basis for a proper risk and return, which means if an instrument is rated highly by a credit rating agency, then the instrument enjoys higher confidence from investors. This gives investors a better understanding of risk associated with the instrument and returns expected. Now let us take a closer look at various credit agencies in India. Credit rating agencies in India have special sections to carry on research and development for work of the industries. They provide training to employees and executives of the company for better management. The CRAs examine the risk involved in a new project, chalk out plans to fight with the problem successfully, and thus manage the risk to a great extent. The biggest and most popular credit rating agency in India is CRISIL. Other popular ones are CARE and ICRA. Let us start with CRISIL. CRISIL, or Credit Rating Information Services of India Limited, is a global analytical company providing ratings, research and risk and policy advisory services. CRISIL's majority shareholder is Standard and Poor's, which is division of McGraw-Hill Financial and provider of financial market intelligence. CRISIL has rated over 60,000 entities in India. Its rating capabilities span the entire range of fixed income instruments, and it has worked with large, medium and small size enterprises. Coming on the rating scale used by CRISIL, starting with CRISIL AAA. Instruments with this rating are considered to have the highest degree of safety regarding timely servicing of financial obligations. Such instruments carry the lower credit risk. Next we have CRISIL AA. Instruments with this rating are considered to have a high degree of safety regarding timely servicing of financial obligations. Such instruments carry a very low credit risk. Next is CRISIL A. Instruments with this rating are considered to have adequate degree of safety regarding timely servicing of financial obligation. Such instruments carry low credit risk. Immediately after that, we have CRISIL Triple B. Instruments with this rating are considered to have moderate degree of safety and carry moderate credit risk. Continuing on with CRISIL rating scale, CRISIL Double B. Instruments with this rating are considered to have moderate risk of default regarding timely servicing of financial obligation. Occurring after CRISIL BB, we have CRISIL P. Instruments with this rating are considered to have high risk of default regarding timely servicing of financial obligation. Next is CRISIL C. Instruments with this rating are considered to have very high risk of default. And lastly, we have CRISIL D. Instruments with this rating are either in default or expected to be in default soon. Next comes CARE Ratings Agency. CARE Ratings is second largest among the credit rating agencies in India as far as a company of Indian origin is concerned. CARE's rating businesses can be divided into various segments. For example, banks, IPO grading, and sub-sovereigns. The company shareholders include leading domestic banks and financial institutions in India. CARE Ratings provide the entire spectrum of credit rating that help corporates to raise capital from their various requirements and assist investors to form an informed investment decision based on the credit risk and their own risk and return expectations. Given on screen is rating process defined by CARE. It begins with agreement between client and CARE. The client submits all the information and detailed schedules to the rating teams assigned by rating agency. The team then analyzes the given information. Finally, the rating committee awards a rating to a client, which a client can accept or appeal and ask for a re-review. Coming to rating scales used by CARE. First is CARE AAA. Instruments with this rating are considered to be the highest degree of safety regarding timely servicing of financial obligation. Such instruments carry lowest credit risk. Secondly, we have CARE AA, which carry very low credit risk. Next is CARE A, which has adequate degree of safety and carry low credit risk. After that, we have CARE Triple B, which has moderate degree of safety and have moderate credit risk. Continuing from the previous scheme, CARE Double B. Instruments have moderate risk of default. Next is CARE B. Instruments have high risk of default. Occurring after that, we have CARE C. Instruments that have very high risk of default. And lastly, CARE D. Instruments with this rating are in default or expected to default very soon. Moving on, let us now talk about ICRA. ICRA Limited is an Indian independent and professional investment information and credit rating agency. It was established in 1991 and was originally named Investment Information and Credit Rating Agency of India Limited, or ICRA India. It is second largest rating company in terms of customer base. It is a joint venture between Moodys and various Indian commercial banks and financial service companies. The company changes name to ICRA Limited went public on 13 April 2007 with a listing on Bombay Stock Exchange and National Stock Exchange. ICRA ratings may be understood as relative ranking of credit risk within India. The ratings are not designed to enable any rating comparison among instruments across countries. Rather, these ratings address the relative credit risk of an instrument within India. Shown on the screen are credit rating scale used by ICRA. Here you see remaining ratings used by ICRA. You can probably understand how exactly it functions. Let us now look at top global credit rating agency. Now we've understood how Indian works, now understand international. The big three credit rating agencies are Standard & Poor's, S&P, Moodys, and Fitch Group. S&P and Moody's are based in the US, while Fitch is headquartered both in New York and London. As of 2013, they hold a collective global market share of roughly 95%, with Moody's and Standard having approximately 40% each, and Fitch for roughly 15% of global market share. Let us talk about Standard & Poor's in more detail. Standard & Poor's Financial Services LLC is an American financial services company. It is a division of McGraw-Hill Financial that publishes financial research and analysis on stock and bonds. S&P is known for its stock market indices such as the US-based S&P 500. As a credit rating agency, the company issues credit ratings for debt of public and private companies and other public borrowers such as governments and government entities. It is one of the several rating agencies that have been designated nationally recognized statistical rating organization by the US Securities and Exchange Commission. Now that we know about S&P, let us take a look at the rating scales of their company. The company rates borrower on a scale from AAA to D. Intermediate ratings are offered at each level between AA and CCC, for example, BBB+, BBB, BBB-. S&P may also offer guidance termed as credit watch as to whether it is likely to be upgraded or downgraded or uncertain. So, investment grades include AAA, and obligor rated AAA has extremely strong capacity to meet its financial commitments. AAA is highest issuer credit rating assigned by Standard & Poor's. Second, we have AA. An obligor rated AA has very strong capacity to meet its financial commitments. It differs from highest rated obligors by a small degree. Includes A. An obligor rated A has a strong capacity to meet its financial commitment but is somewhat more susceptible to adverse effects of changes in circumstances and economic conditions than obligors in high rated categories. After that, we have BBB. An obligor rated BBB has adequate capacity to meet its financial commitments. However, adverse economic conditions or changing circumstances are more likely to lead a weakened capacity of the obligor to meet its financial commitments. We'll continue by taking a look at non-investment grade, also known as speculative grade ratings. First is BB. An obligor rated BB is less vulnerable in near term than other lower rated obligors. However, it faces major ongoing uncertainties and exposure to adverse business, financial or economic condition which could lead to the obligor's inadequate capacity to meet its financial commitments. Next we have B. An obligor rated B is more vulnerable than obligors rating BB, but the obligor currently has the capacity to meet its financial commitment. Adverse business, financial or economic condition will likely impair the obligor's capacity or willingness to meet its financial commitments. Next is CCC. An obligor rated CCC is currently vulnerable and is dependent upon favorable business, financial and economic condition to meet its financial commitments. Occurring after that, we have CC. An obligor rated CC is currently highly vulnerable. Let us continue with S&P rating scales. C imply that the company is highly vulnerable, perhaps in bankruptcy or in arrears, but still continuing to pay out on obligations. Next is R. R rated obligor falls under regulatory supervision owing to its financial condition. During the pendency of regulatory supervision, the regulators may have power to favor one class of obligation over others or pay some obligations and not others. And lastly, a rating of D. implies that obligator has defaulted on obligations, and S&P believes that it will generally default on most or all obligations. Moving on to Fitch Ratings. Fitch Ratings Inc. is one of the 3 nationally recognized statistical rating organizations, NRSRO designated by US Securities and Exchange Commission in 1975, together with Moodys and Standard and Poor, and the 3 commonly known as the Big 3 credit rating agencies. Fitch Ratings is Fitch Rating is a provider of credit ratings, commentary, and research. It offers global perspective shaped by strong local market experience and credit market expertise. Moving on to the scale of Fitch. So investment grade includes, firstly, AAA. The best quality companies, reliable, stable, have a AAA rating. Secondly, we have AA. These are quality companies, but they come with little risk, higher than AAA. Next is A. The economic situation of the company can affect their finance. And next we see BBB. This includes medium class companies which are satisfactory at the moment, actually. The non-investment grade is inclusive of the following. First is BB. These companies are more prone to the changes in the economy. Next we have B. The financial situation of such companies varies noticeably. Next is CCC. These companies are currently vulnerable and dependent on favorable economic condition to meet its commitments. Directly after that we have CC. These companies are highly vulnerable and have very speculative bonds. We have a rating of C occurring after that. Such companies are highly vulnerable, perhaps in bankruptcy or in arrears, but still continuing to pay out obligations. Immediately after that we have D. These companies have defaulted on obligation, and Fitch believes that they will generally default on most or all obligations. And lastly, NR. It means these companies are not publicly rated. Finally, we come to Moodys. Moodys Investor Services, often referred to as Moodys, is bond credit rating business of Moodys Corporation, representing company's traditional line of business and historical name. Moodys was founded by John Moody in 1909 to produce manuals of statistics related to stocks and bonds and bond ratings. In 1975, the company was identified as a nationally recognized statistical rating organization, NRSRO, by the US Securities and Exchange Commission. Moody's Investor Service provide international financial research on bonds issued by commercial and government entities. Moody's Investor Services rates debt securities in several market segments related to public and commercial securities in the bond market. These include government, municipal, and corporate bonds, managed investments such as money market funds, fixed income funds, and hedge funds. Given on the screen are long-term and short-term credit rating according to Moody's. Credit rating provides an investor credit worthiness of financial instrument issued by a large institutions. The ratings are also linked closely to return on investment. If a bond is rated safe, then expected return will be lower, and if a bond is rated risky, then expected returns will be higher. It follows simple principle of high risk and high return. Given on screen is comparison of global credit rating scales as defined by Moody's, Standard & Poor's, and Fitch. All credit agencies have an internal method of grading any financial entity or instrument. Ideally, the grading of all the agency is not expected to differ much. But if there is a significant difference, for instance, if Moody's has rated an asset a AAA and S&P has rated the same asset at CCC, then investor must undertake a meticulous investigation to understand the reason for difference. But as a general rule, the rating assigned by different agency will not differ very greatly. This completes this session on credit rating agencies. Thank you for your time.